Your ESPP has the potential to give you a 17% return in just 1 second. But there's a catch. You could still mess this up even though you're contractually given massive benefits. So buckle up as we uncover the thrilling truth behind ESPPs, how they work, and if you should even contribute. An ESPP stands for Employee Stock Purchase Plan. It's a company's way to incentivize you, their employee, to stay at the company and be invested at their success by giving you access to their stock, oftentimes with some pretty sweet deals attached. On the other hand, if you twiddle your thumbs all day, you might not have much of a payout. It's easiest to understand an ESPP chronologically, so here's a timeline of your ESPP. There are 4 important time frames you should know about. We're gonna start with the time that literally gives you the potential to out-earn your coworkers. The official title of this time frame is the Enrollment Period. This is a time period where you have to make a couple important decisions. 1, whether or not to participate in the ESPP, which I'll discuss later. And 2, if you do participate, how much of your gross income do you want to contribute? Be aware that tax law currently caps the amount of company stock you're able to purchase through an ESPP at $25,000 annually. According to the National Association of Stock Plan Professionals, most companies have less than half of their employees contributing to their ESPP. Most of your coworkers are underutilizing the potential given to them. So if you participate in your company's ESPP, you're literally going above average and can likely out-earn your coworkers. The second important time frame for ESPPs is the offering period. This is where the enrollment period ends and your company starts withdrawing that predetermined amount from each paycheck. A typical offering period lasts 6 months, and like a 401k, it's withdrawn from your paycheck. But unlike a traditional 401k, it's withdrawn after tax. What if you have regrets during the offering period? Perhaps you're contributing a larger portion of your paycheck than you can currently afford. Your company may allow you to suspend, withdraw, or change your contribution percentage during the offering period, but every company is different, so check with your company's ESPPs about its current rules. Just know that your contributions aren't actually being used to purchase stock at this point. The company is holding your contributions on the side in a trust and waiting for the third important date, the purchase date. This is the day where your company actually uses your contributions to buy company stock. And on this day, you have as many taxes as I have friends. And because I don't have any friends, you just don't have any taxes. On this day, there are no taxes for qualified ESPPs. Tax is deferred until you actually sell, which is the great thing about qualified ESPPs. If you're participating in a non-qualified ESPP, any difference between the purchase price that you paid for it and the fair market value on the date of purchase is going to be taxed as ordinary income, subject to withholdings. The good news is on the purchase date, you're going to receive more benefits than just receiving company stock. It's common for companies to offer 3 additional benefits for participating in the ESPP. Before we dive into these benefits, let's quickly cover the last important day that you need to know, which is the date of sale, also known as the date of disposition. The great thing about this date is that you get to choose when to sell, which gives you so much flexibility and lots of opportunities to strategize. The not so great thing about this day is that you're triggering taxes. The taxation of ESPPs is quite complex. I'll get to that in a minute, but I mentioned the additional benefits for participating in an ESPP. Let's dive into those now. The first benefit is a provision that allows you to purchase stock at the lower of 2 prices, the purchase date or the first day of the offering period. Buying low and selling high is the whole premise behind investing. So having the ability to contractually buy low can make a huge impact on your return. Speaking of massive returns, if you're wanting a return on your personal capital, hit the subscribe button. This benefit is known as the look back provision, and in addition to the look back, your company may stack another benefit on top of that, which is a discount of up to 15% off your company stock. So not only are you getting the lowest price off of the look back, but you could be getting a discount off of that price. The best part about the 15% discount from your ESPP is that it doesn't actually equal a 15% return. It's actually more than that. I polled my LinkedIn followers to show you how unintuitive this is. I asked them which they'd prefer to receive, a 15% return or a 15% discount. Here's the results. I believe that 80% of people chose the wrong answer, including financial planners, CPAs, PhDs, and other financial professionals. Here's why I favor the discount over the return. Let's say that I have $100 to invest. If I get a 15% return, I'll pay $100 and gain $15, making my end balance $115. In comparison, let's say that I still have that $100 to invest, but I'm given a 15% discount. I'll pay just $85 to own that $100 investment. As such, I immediately gained $15 of value. Plus, I got to keep the $15 of value that I would have otherwise spent on the $100 investment, making my end balance $115. Even though the outcome is the same, I'd still take the discount. Why? Because it took less of my cash to get the same value. What's more, the discount got me a larger return. Here's how. We just talked about a $100 investment with a 15% return gets me $15. In the case of the discount, I only invested $85, but the stock was worth $100, so I got $15 of value. Here's what everybody misses. What return on $85 is needed to produce that $15? It can't possibly be 15%. How could 100 times 15% be the same as 85 times 15%? If you do the math, it actually requires a higher return for $85 to produce the $15, a 17.64% return to be exact. So the investor who chose the 15% discount over the return got a higher return with less money. And I call that a win. Although a 15% return versus a 17.64% return isn't a huge difference, every little bit helps. And I'd take the discount over the return any day. To be fair, there was a lot of context left out of the poll, so I'll give everyone a benefit of the doubt. But I think it's safe to say that you've become above average again. So if you're finding value in this video, please hit the like button. Okay, so now that we understand that it's a 17% return, how do you go about getting it in just 1 second? Assuming your company offers the max 15% discount, on the purchase date, they'll take all of your contributions during the offering period, apply the 15% discount, and purchase the stock. So does that mean that it's a 1 second return? Yes and no. Technically speaking, as soon as they apply the discount, you get an immediate 17.64% return. It may not be a realized gain, however, especially if you make some of the common mistakes that I'll tell you about in just a minute. But first, let's talk about the third benefit that you may receive by participating in your company's ESPP. If you choose to hold your shares 1 year from the purchase date and 2 years from the first date of the offering period, then your taxes switch from ordinary income to the advantageous long-term capital gains. This is called qualifying disposition and is only available in qualified ESPPs. Much like a 401k match can be viewed as free money, the benefits offered by your ESPP can also be viewed as free money. Of course, it's not a guarantee, but it's still a pretty good chance. Yet ESPPs aren't all sunshine and happiness. Let's look at some common mistakes that some people unsuspectingly fall into, then we'll talk about whether or not you should participate. Mistake number 1, I'll start with this. Think about it. You may be overexposed to your company via your salary, stock options, RSUs, ESPP, and so on, putting your income and your assets into one effective basket. If anything terrible were to happen to the company, you could lose your income and your assets. Ouch. Mistake number 1 is concentration risk. Please don't make this mistake by forgetting about the importance of diversification. If you're looking for a professional to help you diversify out of company's stock in a tax-efficient manner, my firm specializes in this and we have limited room for new clients. More information in the description below. Mistake number 2 is being unaware of this. After the ESPP purchases the stock, some companies enforce a mandatory holding period where you're unable to sell the stock. So by the time you're able to sell, the stock price may have dropped. Maybe so far that the look back and the discount were virtually useless in providing you any gain. Even if there is no holding period, you may not be able to sell after the discount is even applied. This is why your 15% contractual discount might not actually equate to a 17% return, or any return at all. Investing involves risks, and this is one of them. Depending on the volatility of the stock, a 15% price movement may or may not be likely in a short period of time. But past results don't predict future performance. Mistake number 2 is being unaware of holding period or market volatility. You can avoid this mistake and manage your expectations through a tip that I'll address in just a minute. Mistake number 3 is this. When you pay your taxes, the discount is correctly reported on Form W-2. A problem rises, however, if your broker, for example, Fidelity or E-Trade, reports that same income on Form 1099-B. Mistake number 3 is double taxation. So avoid this mistake by paying attention to your cost basis on Form 1099-B. You may have to make an adjustment to avoid double taxation. Mistake number 4 trips up even the best financial and tax planners. There's a little quirk in the tax code that makes the highly coveted qualifying disposition make you pay more in taxes, not less. This trap occurs when the qualified ESPP has a look-back provision and the stock price is lower on the purchase date than on the first day of the offering period. And this is called the qualifying disposition trap. And mistake number 5 is participating when you can't afford it. I'll address how to circumvent this mistake in tip number 1. With all these mistakes looming in your mind, you may be a bit scared, wondering, well, should I even participate in my company's ESPP? And the correct answer is, it depends. Here's when it might make sense. You might consider participating in your company's ESPP if it aligns with your values and goals, you have a high risk tolerance and capacity, and your finances are in order. For instance, you've got an emergency fund in place, minimal low interest debt, a healthy retirement egg, you're already maxing out your company's 401k match, you have sufficient income to meet all of your needs, and other unique personal factors. While this isn't an exhaustive list, these are just a few things to get you thinking. Also remember that the information provided in this video is not intended to be a substitute for specific individualized tax, legal, or investment advice. As such, please work with your professional. If any of those things don't describe you or your personal financial situation, then it currently might not make sense for you to participate in your company's ESPP. This isn't a permanent decision, but rather you might consider delaying your ESPP contributions for a later date when it might make more sense. For those that participate, there are some strategies to help you decide when to sell. Let's talk about a few of these strategies before I get to my 3 tips. Strategy number 1 is known as flipping the stock. The purpose here is to participate in your ESPP just to take advantage of the look back and the discount. You're not interested in holding companies' stock, and especially not for the long term. So you sell the stock as soon as possible after the purchase date. There's less time for the stock price to move if you act quickly. So you're more likely to solidify the discount and the look back. That being said, financial planning is about trade-offs. So in this case, you are surrendering the long-term capital gains tax rate for a portion of your proceeds. Also, this strategy only really works if your company hasn't imposed a lengthy holding period. Out of all of the strategies, this one can make a lot of sense unless the look back dramatically reduces the purchase price. That being said, this approach probably isn't for you if you're wanting to hold the stock for the long term, your company has implemented a holding period, or you want to get the best tax rate through qualifying disposition. If you're finding value in this information, please hit the like button. Strategy number 2 is achieving qualifying disposition. Right off the bat, you need to know that this strategy only applies to qualified ESPPs. While this approach is focused on a better tax rate, you're also taking on more risk because you're holding the stock for longer periods of time. To get qualifying disposition, you have to wait 1 year from the purchase date and 2 years from the first date of the offering period before you sell. In that time, the stock price could drop to the point where the discount and the look back didn't provide you any value. Oh, and if your plan has a look back provision, you may run into the qualifying disposition trap that I mentioned earlier. While this strategy has lots of gotchas to consider, it may make sense for certain financial situations. Most of the time, however, I wonder if this is really worth it for most people. Strategy number 3 is right in the middle of the other 2 approaches. You're not selling as soon as possible, and you're not waiting for qualifying disposition either. This approach isn't necessarily recommended when compared solely against the other 2 approaches. Why? It brings added risk of losing the look back and the discount, and you don't get the best tax rate. That being said, your unique circumstances may warrant an approach like this. For example, if you don't want to incur taxes in the year that the stock was purchased, and you also don't want to wait for qualifying disposition. And that is what I call tax planning. Now onto my 3 ESPP tips. To help you retain all of this, I've created a free ESPP guide available for download in the description. Now onto my 3 ESPP tips. When it comes to tip number 1, your 2 options aren't max it out or don't participate at all. Taking advantage of the ESPP doesn't have to make you go broke. If you're early in your career and on a starter salary, having those contributions pulled from your paycheck may make budgeting extra tight. What's more, you might not be able to back out of your ESPP for 6 months. Tip number 1 is remembering that you can partially participate. You should consider your cash flow and only participate if you can afford having those contributions pulled from your paycheck. You can start with smaller contributions and build your way up over time. Tip number 2 applies to almost every single one of the hundreds of people that I've helped with their equity compensation. As you make decisions surrounding your ESPP, don't just pay attention to the tax ramifications, because that's not the most important consideration when making financial decisions. In fact, there are 2 things to look at before you even consider taxes: your values and goals, and your risk tolerance and risk capacity. If you're making financial decisions solely based on the tax ramifications, you're doing it wrong. And that is why tip number 2 is evaluating your finances holistically. You need to know what you value in life. What are your goals and how will your finances help you achieve them? How you feel about taking on risk, and how much you're even able to take on financially. Once you've fleshed out those important details, then you can consider taxes. Tip number 3 doesn't have to be a huge time commitment, but just know that not every discount is 15% and not every enrollment period is 6 months. So understanding the rules of your company's specific ESPP is crucial to making decisions. These rules are the foundation upon which you build your strategies and avoid making big mistakes, because one single day could make a huge impact on your taxes. Tip number 3 is to read the ESPP document. This line represents potential sale prices, and beneath it shows the potential tax outcomes for your ESPP depending on when you sell. Here's how to successfully navigate ESPP taxes in this video right here.